Guys, I have to share this breaking news with you immediately. Here's what happened. The global financial landscape has been dramatically reshaped by the words of a 72-year-old man. The financial world is witnessing a historic turning point. After months of criticism from Trump and relentless pressure from Wall Street, Jerome Powell has finally signaled a major shift in stance at the Jackson Hole Symposium. There is no doubt that Powell was the global focus on August 22 ND. In what is likely the final major financial event of his career. His words sent global markets reeling the moment he spoke. The balance of risks is shifting, and it may be necessary to adjust the policy stance. In plain terms, folks, we can't hold on anymore, we're going to cut interest rates. This single statement drove a $2.3 trillion surge in global stock markets in a single day. It pushed U.S. stocks, U.S. Treasuries, gold, European equities, and Bitcoin to rally across the board. Trading screens worldwide were awash in green, with only short sellers left bleeding. This one sentence effectively locked the wealth opportunities for the rest of 2025 firmly in place. So, what exactly did Powell say and imply that triggered this massive financial surge? The answer is as simple and familiar as it gets, the two words we've all been waiting for. Rate cuts. As many anticipated, given that central bank symposiums have always been a key signal for the Fed's next policy moves, this wasn't just any ordinary rate cut hint. This marked a complete 180-degree shift in the Fed's stance, effectively ditching its inflation fighter image and placing employment risks above inflation. Hey everyone, I'm Luna, here to break down macro trends into plain portfolio talk. Today, let's dive into who really pushed Powell, the man holding the reins of the US economy, to make this move? Why did he have no other choice? How will Fed rate cuts benefit markets? And most importantly, how can retail traders like us position wisely? Understand this now, and you could position yourself early for the next market wave. Miss it, and you might be buying at the peak after September's FOMC news. Stay sharp, trade smart. I spent 2 whole days and nights breaking down the every detail of Powell's speech transcript, internal minutes, and data from all parties. Today, let's cover everything in one go. First, let's take a look at what Powell actually said. Chairman Powell's latest remarks struck a stark contrast with expectations. Completely defying his typical hawkish image, markets were braced for another rigidly hawkish performance. Another stern reaffirmation of no rate cuts until inflation is truly defeated, another display of his trademark impassive poker face meant to unsettle investors. After all, Trump's recent tariff hikes had fueled a renewed surge in goods prices, fanning the flames of inflation and leading many people to believe the Fed would feel forced to lock into ultra-hawkish mode, vowing to keep rates high even at the cost of economic pain. But instead, Powell caught everyone off guard. He came out and delivered a surprise gift to global markets, openly paving the way for rate cuts. So what exactly did he say? Let's break it down. The risks to achieving our employment and inflation goals are moving into better balance. We will need to adjust policy in response. Pay close attention to the phrase, adjust policy. Right now, the Fed is running a restrictive policy. Like keeping the economy on a tight leash, rate cuts have been largely off the table with inflation still simmering. But by openly mentioning adjustment, Powell is signaling that the leash is about to be loosened. The Fed is likely to shift first to a neutral policy, then gradually toward full accommodation, paving the way for broader, more flexible rate cuts down the road. This isn't just a minor tweak. It's a major pivot that has reshaped expectations not only for the September meeting but through the end of this year and into 2026. Looking through the full text of Powell's speech, this marks the first time he has openly signaled a willingness to consider rate cuts. Though relatively brief, every sentence was packed with meaning. I listened to it 5 times and uncovered 3 key signals. What are they? Don't worry, let's break them down one by one. Signal number 1, employment. Over the past 2 years, Powell's biggest fear was inflation. Now it's unemployment. Here's how he put it literally: the labor market is in a peculiar balance, so what's so peculiar about it? The peculiarity lies in the fact that although the U.S. unemployment rate has held steady at 4.2, seemingly stable and unchanged, this isn't actually a sign of robust economic health. Rather, it masks underlying vulnerabilities. Job openings have declined, but so has immigration, meaning there are also fewer people seeking jobs. So even as available positions shrink, the surface illusion of stability remains. Pretty intriguing, isn't it? That 4.2% unemployment rate is being artificially propped up by a declining labor force participation rate. If businesses shift from simply not hiring to outright layoffs, the unemployment rate could jump abruptly like a fault line giving way. And if an employment crisis erupts before the Fed starts cutting rates, a recession would become almost inevitable. Previously, Powell relied on strong economic data to justify holding rates high, but this sharp downturn seems to have struck a nerve deeply. Signal number 2, tariffs. This is the first time Powell has defended Trump's tariff policy, arguing that the resulting price increases are a one-time shock rather than an ongoing inflationary threat. But let's rewind back on April 16th. Powell explicitly warned that Trump's tariffs could lead to a temporary but prolonged spike in inflation. So why the sudden 180-degree turn just 4 months later? Could it be that the Fed is already laying the groundwork for a September rate cut? It certainly looks that way, with the inflation anchor effectively pulled. The floodgates for liquidity appear ready to swing wide open. Signal number 3. Revising Fed strategy: a return to a flexible inflation targeting framework. The much-hyped average inflation targeting regime introduced in 2020 has been unceremoniously dumped. That policy allowed inflation to run above 2% for some time to make up for periods when it was below target. Abandoning it now signals a return to a stricter 2% inflation goal. This is a more conservative and rigid approach. Of course, this shift makes sense when you consider how severe U.S. inflation has become a far cry from the conditions that inspired the old framework. Most of us have felt that difference firsthand. At the same time, the Fed's approach to employment has also evolved. It's no longer just about preventing a weak labor market, keeping it from getting too cold. It's now also about preventing it from overheating. In short, the Fed is trying to strike a more deliberate balance between employment and inflation. The central bank is transforming from an inflation fighter into something closer to a full-time employment nanny. Together, these 3 signals amount to burning the higher for longer banner that flew over the past 2 years. Powell isn't just hinting at rate cuts, he's striking a tone that's far more dovish than anyone expected. So what's really behind this shift? Why is Powell being forced to pivot so dramatically? This shift has left many market watchers puzzled. After all, Powell has consistently stressed the Fed's commitment to fighting inflation. Back in 2022, amid widespread market skepticism toward rate hikes, he moved decisively with tightening. Then, throughout 2023, without turning overtly hawkish, he stayed cautious, remaining professionally reserved, repeating data dependent consistently, and keeping policy steady. This new direction feels distinctly out of character. So what's really driving this reversal? Could it be that Powell, worn down by Trump's constant pressure, is finally yielding? Let's dig deeper. Powell is now walking a tightrope. On one side, the president is blasting in his ear like a loudspeaker, "Cut rates. Cut rates now." On the other, there's the Fed's deeply ingrained dual mandate: stable prices and maximum employment. These 2 goals are like high voltage lines, he can't touch either. Yet both define his every move. Now both are flashing warning signs, leaving him torn between a rock and a hard place. Let's start with inflation. Although CPI has come down significantly from its peak, it's still not quite at the Fed's cherished 2% target. Over recent months, importers and retailers have been quietly absorbing the costs from tariffs, afraid that raising prices would scare away customers. But there's only so much cost pressure businesses can swallow eventually. Producers have to pass some of it down the line. That's what's starting to happen now. Powell can't help but worry. What if I cut rates now, and inflation comes roaring back climbing to 4, even 5%? What then? Then there's employment. As highlighted earlier, all three signals from Powell tie back directly or indirectly to the labor market. The unemployment rate looks stable at 4.2%, but the declining labor force participation rate is masking the fact that real job growth is actually slowing. Powell knows all too well, if the job market tanks, not just Trump but Congress will haul him in for hearings, but if he cuts rates too early just to save jobs, and inflation comes back to bite, his credibility could collapse entirely. On top of all this, internal disagreements within the Fed and Sky high market expectations for rate cuts are also weighing heavily on his final decision. Alright, now that we understand why Powell is making this move, let's turn to the most critical question. What happens once rate cuts are all but confirmed? First to change will be market expectations. Before Powell's speech, according to FedWatch data, the probability of a 25 basis point cut in September was already high, but after he spoke, it shot up to over 90%. At the same time, the market began pricing in 3 cumulative rate cuts through 2025. These shifting expectations were immediately reflected in asset prices across the board. Pretty much everything, everywhere went up. That night, Bitcoin jumped 4%, the Dow and Nasdaq each gained around 1.5%. Hang Seng Index and Hang Seng Tech Futures also rose roughly 2%. Stock indexes in Europe and Japan climbed as well, while gold gained about 1%. After all, with the world's primary settlement currency, the US dollar, set to become more abundant, liquidity will lift all boats. But friends, let's be clear, a rate cut isn't like Santa Claus handing out candy. Money doesn't just fall from the sky. So where will it flow? Actually, if you look back at the past 6 rate cutting cycles, asset performance followed a script like 6 different movies, each with the same plot. Today, I'll lay that script out for you. Once you understand the logic, all you have to do is follow it. So what does a rate cut really mean? It means lower borrowing costs. That tends to benefit the growth stocks of sensitive to valuation changes and high dividend value stocks with elevated debt levels or high financing needs. Take tech leaders like Nvidia and Tesla. For example, the logic is straightforward. Their valuations are heavily tied to future cash flows, which look more attractive when discounted at lower rates. That said, back in March 2020 when the Fed slashed rates to 0-0.25%, the Nasdaq soared 82% before any meaningful pullback. But the ones who really cleaned up were just 5 giants: Apple, Microsoft, Google, Nvidia, and Amazon. Here's why. Institutional investors have deep pockets, but they also have a strong preference for cold, hard cash flows. When rates fall, they pour money into profitable market leaders that buy back shares and pay dividends, not into unprofitable PPT companies that are still burning cash. Second, interest rate cuts typically lead to lower real interest rates, which directly benefits assets such as gold, telecommunications, and utilities. Speaking of gold, some might ask, didn't it fall recently? That's true, but that was before Powell's speech. Had he taken a hawkish stance this time and further cooled expectations around rate cuts, gold prices could indeed have continued to decline. But instead, he pivoted dovish. Gold is bound to rebound quickly, closing the current short side gap. Let's start with the formula. Real interest rate equals nominal interest rate minus inflation expectations. When nominal interest rates fall, real rates usually follow. And gold prices have historically shared an inverse relationship with real interest rates. As real rates decline, investors become more inclined to allocate to non-yielding assets like gold, since the opportunity cost of holding it decreases. At the same time, in an environment where inflation expectations are rising, gold becomes more attractive as an inflation hedge. Meanwhile, rising employment risks indicate increased safe haven demand in the market, which provides dual support for gold. Historical data backs this up. Over the past 6 rate cutting cycles, gold gained an average of 14% in the 6 months following the first cut. This time, with central banks around the world stockpiling gold, $3,300 per ounce is hardly the ceiling. As for utilities and telecommunications companies, their business models rely on stable cash flows and high dividend yields to attract investors. Lower financing costs directly improve their cash flow, strengthening their ability to sustain and even raise dividends, which in turn draws more long-term capital. At the same time, amid growing uncertainties such as employment risks and market volatility, defensive sectors are likely to attract more attention. Sectors such as consumer goods and healthcare are poised to gain greater upside potential. While less exciting than tech, they offer more stable cash flows, stronger risk resistance, and greater long-term sustainability. Remember this: when the market grows fearful of high valuations, money flows into cheap and high-yielding safe havens. Additionally, amid the backdrop of tariff policies and the onshoring of industries to the U.S., domestic energy, manufacturing, and infrastructure sectors are benefiting from more stable policy environments and protection. Chairman Powell's remarks did not frame inflation as a long-term threat, which suggests two important messages. First, the Fed is unlikely to abandon interest rate cuts due to short-term oil price increases. And second, it won't tighten monetary policy solely in response to temporary price fluctuations caused by manufacturing expansion. In a move that surprised many, Warren Buffett recently invested in an industry that most had avoided for the past 2 years, real estate. What does he see that others don't? Is his bet actually a strategic positioning ahead of the Fed's anticipated rate cut in September? The recent deep freeze in the housing market, with 30-year mortgage rates soaring above 7%, was largely driven by the Fed's aggressive rate hikes. Now that the signal for rate cuts has been sounded, could real estate be heading for a spring? Take a look at REITs and the real estate value chain. REITs are essentially securitized real estate assets. They generate income by investing in properties like office buildings, residential complexes, and shopping malls. Then distribute rental dividends to investors. Their prices are highly inversely correlated with mortgage rates. When interest rates fall, financing costs decline, boosting the stability of REITs' cash flows and attracting long-term capital. Currently, the 30-year mortgage rate has been declining steadily, and expectations for rate cuts are already priced in. Builders like Dreyers Horton and Lennar are seeing improved order volumes, and let's not forget Warren Buffett quietly increased his stakes in 2 homebuilders last quarter. The writing is on the wall, but after all this talk of opportunities and positive signals, with rate cuts sounding like cause for celebration, I have to bring things back down to earth. Behind the excitement lurk 2 hidden risks that could devour returns. Anyone diving in blindly could get buried. The first is the looming black hole of U.S. Treasury debt. Consider this: the U.S. government is now $37 trillion in debt, roughly $110,000 per American. Even more staggering, the annual interest payment alone has reached $1.1 trillion, exceeding the combined budgets for national defense and Medicare. Where will the money come from? Only by issuing new debt to repay the old. At the end of July, the Treasury Department auctioned off 30-year bonds expecting strong demand. Instead, the bid-to-cover ratio, a key measure of auction appetite, came in at just 2.14. The lowest since the 2009 financial crisis. Simply put, no one is buying. If the September non-farm payroll data comes in surprisingly weak, meaning a sudden collapse in employment, the market will immediately shift from expecting precautionary rate cuts to recession panic. In such a scenario, capital would rush into long-term U.S. Treasuries. Long-term yields would plummet, driving Treasury prices sharply higher. Equities would experience a seesaw effect. The bond market feasts, while the stock market bleeds, particularly high valuation tech stocks. A second wave of valuation compression could arrive without warning. So what should you do? If this situation actually plays out, here's the strategy. Set a stop loss at -5% for Nasdaq ETFs and overbought tech stocks. If it hits, sell without hesitation. The second undercurrent is the election black swan, which could take flight at any moment. Trump is currently leading in the latest polls, with 3 presidential debates scheduled for September and October, plus the possibility of an early leak of the October non-farm payroll data. Volatility could spike. Remember, back in October 2018, when Trump declared, "The Fed has gone crazy," the VIX Fear Index surged 40% in a single day. If this year he threatens to fire Powell if he doesn't cut rates fast enough, market volatility could go through the roof. So here's the plan. Treat a VIX level above 20 as a red light. Whenever the fear index closes above that threshold, immediately reduce your exposure by 30%. Hold cash, stay patient, and when the dust settles, pick up undervalued assets on the cheap. All these strategies are distilled from patterns repeated throughout history. As the saying goes, history doesn't repeat itself, but it often rhymes. At the peak of the dot-com bubble in 2000, the Fed's final preemptive rate cut gave the Nasdaq 3 more months before it crashed, while the Dow weathered the bear market with value stocks. In September 2007, the first rate cut sparked a rally in financial stocks. Yet 12 months later, the global crisis hit. In March 2020, unlimited QE rate inflated the tech bubble. Today, we're standing at that same crossroads in time. Powell's concession isn't a victory lap, it's a bargain buying time against a recession. When the feast is wildest, the bill comes closest. While we chase opportunities brought by rate cuts, risk control is crucial. 1. Set stop losses. 2. Manage position sizes. 3. Boost emergency savings, pay down high-interest debt, and upgrade your skills. Balancing returns and risk is how you stand firm in shifting cycles, not become another casualty of volatility. When the next bell rings, may you be at the table, not on the menu. I'm Luna, helping you decode macro trends and turn them into your portfolio's bottom line. See you in the comments. Catch you next time.